Maintaining a list of potential stocks to buy and track is an ongoing process. Especially during the COVID-19 stock market turbulence, you should keep an eye on lists like IBD Long-Term Leaders and IBD 50. But don't just invest in any of these picks blindly. You need to understand your risk tolerance and investment goals. 1. Focus on fundamentals. Many investors look at a company's financial performance and business prospects when deciding whether to buy or sell stocks. This approach is known as fundamental analysis. It involves looking at the underlying business and evaluating metrics like earnings per share, EPS growth, price-to-earnings ratio, and sales trends. This type of stock analysis has long been a popular strategy for long-term investors. But during times of market turbulence, it's even more important to focus on companies with solid fundamentals that can weather a downturn. While it's impossible to predict how stocks will perform over short periods, you can identify the best fundamental stocks by looking for the following characteristics. The best fundamental stocks are profitable and have durable competitive advantages that should allow them to maintain profitability or grow. Ideally, the company also has significant growth opportunities and scale. In addition, a good fundamental stock would trade for a discount to its long-term value. This makes it an attractive buy in a challenging market. For example, the retail tax services company H&R Block, HRB, has a strong competitive advantage, a high customer retention rate, and a proven track record of profitability. The company is also trading for a significant discount to its long-term value. It's also important to consider the broader economic environment when choosing fundamental stocks. For example, the current market rally may be driven by hopes for a soft landing by the Fed and optimism over peaking inflation. These factors could lead to higher interest rates and a slowdown in the economy that will eat into profits at some companies. As a result, it's especially important for new investors to focus on stable companies with simple business models that are easy to understand. You should avoid cutting-edge technology, advanced biotechnology, and complex finance sectors unless you have the knowledge to make confident investment decisions in these areas. It's also helpful to choose stocks with positive net income in at least 4 of the last 5 years. Finally, a consensus analyst buy rating is an excellent indicator that the company has strong fundamentals and is likely to outperform the market. 2. Look for chart patterns. Stock charts are one of the best tools you have for understanding price movements and identifying the best stocks to buy. They reveal underlying trends in a stock's performance and indicate whether a company is being supported or rejected by big investors. For example, you can see if mutual funds and other large investors are buying or dumping shares of a company. This can help you determine whether a stock is due for a bounce or a crash. The good news is that chart patterns tend to repeat, so if you understand the basic principles behind them, you can better predict where a stock may be headed. In fact, some stocks will make a major move after forming certain pattern formations, such as the cup with handle or double bottom. Investing. Tip: investing in stocks that have formed these pattern formations is a smart strategy for 2 reasons. First, these formations typically occur during market corrections. And second, they often occur at the same time as the market indexes are beginning to regain their momentum. This is known as the buy point effect and is important to keep in mind when looking at these patterns. As an added benefit, you'll find that the types of stocks that form these formations typically have strong fundamentals. For example, Microsoft is a solid choice for risk-tolerant investors because of its ability to weather market turbulence and economic headwinds. Likewise, Nvidia is a tech powerhouse that has grown rapidly over the past few years thanks to its focus on graphics processing units and artificial intelligence. In addition to the technical indicators listed above, you can also use the daily and weekly chart of a stock to track volume to help identify potential buy points. For instance, you can see if there are many trading days when the stock trades sideways to digest its earlier gains. This is referred to as a flat base, or if it moves up and down in a tight range. In either case, these signs are indicative of institutional investor activity and can signal when a stock is ready to break out of its base and continue higher. 3. Look for value. Value stocks are those that trade below the price that analysts feel the company is worth based on financial ratios like price to earnings and price to book. These companies are undervalued and may be overlooked by investors who focus on growth or momentum stocks. Oftentimes, this is because of a bad news event or something the public doesn't understand about the company, such as a major scandal or an unethical business practice. This is why it is important for investors to conduct thorough research before making a sizable long-term investment in any stock. This means understanding the industry, competitors, and analyzing the company's statements such as the balance sheet. This can be a daunting task, but it is necessary to determine whether or not the stock is the best fit for your portfolio. One of the most popular ways to find value stocks is to search for value or best buy articles on stock market forums and websites. However, many of these articles are quickly written by freelance writers who don't even own the stocks they recommend. They are chasing clicks and page views rather than providing quality information to their readers. This can lead to false leads and a lot of wasted time for investors. A better way to find value stocks is by using an online screener that compares values based on fundamentals. A quality screener will look at factors such as price to earnings, return on invested capital, and more. Then, it will rank the top stocks based on these metrics. This can help you narrow your list down to the most promising stocks that are set to outperform in the future. Despite the 2022-23 bear market, there are still some great value stocks out there. These include non-cyclical companies with strong dividends and those that have a large economic moat to protect them from competition. These companies are trading at discounts to their true worth and should do well for the foreseeable future no matter where interest rates and the economy are headed. While they won't perform as well as they did in the recent bull market, they should provide solid returns over the long term for patient investors. 4. Look for dividends. Dividend stocks have historically accounted for a large portion of the stock market's total return. However, a dividend is only as good as the company that pays it. This year, investors should look for stocks with sizable yields from companies that are sustainably growing their dividend payouts and earnings. In a volatile market, investors can find comfort in the fact that some stocks pay stable and growing dividends, which help mitigate price fluctuations. These stocks also offer a steady stream of income for long-term investors. In addition to finding attractive dividend yields, investors should also seek out stocks that have a durable competitive advantage that can protect them from competitors and allow them to grow their profits for years to come. Investors looking for a consistent source of income should also consider cyclical dividend stocks, which can provide an opportunity to capture gains that may be difficult or impossible to achieve during a bull market. These stocks often offer high dividend yields in exchange for a lower share price, making them more affordable for investors with risk tolerances that can handle periodic declines in the market. The best stocks to buy will always depend on each individual investor's unique situation and risk tolerance. Instead of simply following the advice of experts in the financial media, investors should research the stocks on their own and make decisions based on what they learn and how it relates to their own goals and investment timelines. Using tools available on financial websites, investors can easily screen for dividend growth stocks. They can use these tools to look beyond factors such as company size or investing styles and focus on a company's profitability, cash flow, and other indicators of quality. If a company generates more cash than it needs to operate its business, it can do a number of things with the excess, including buying back its stock or paying a juicy dividend to shareholders, writes Kiplinger contributing writer Will Ashworth. And if the company experiences a recession, it can still pay its dividend even while its shares fall. A good rule of thumb is to choose stocks with a dividend yield of at least 2%, but don't be afraid to go higher to ensure that you're receiving solid returns for your efforts.